Hi, I'm Mike Richter, and today we're going to be talking about Monopoly. Now, honestly, Monopoly is one of the best ways to learn a very powerful real estate strategy that's available based on a little known part of the U.S. tax code. So let's go ahead and give you an overview of what we're going to be talking about today. Well, first I'll give you a quick review of the game of Monopoly. Then we'll talk about the magic of exchange, which is the key principle to learn from Monopoly as far as real estate investing. Next, we'll talk about the benefits of using this little known tax rule, as well as the rules associated with it. And then I'll highly emphasize the biggest pitfall. Before we get into the content of the video, I want to make sure that it's entirely clear that I am not an attorney, nor am I a tax professional. So you want to verify and seek the counsel of a competent advisor for the purposes of executing on this strategy for yourself in your own real estate business. So let's get started. So Monopoly is a very awesome board game. It was one of my favorite board games growing up, and it's still one of my favorite games to play. Right now, my kids are only 5 and 6, so we play Monopoly Junior from time to time, and it gives them kind of the idea of what we do out in the real world by renting houses and finding good places for people to live. But the basic idea of Monopoly is you cruise the board and you buy properties. One of the cool things that not a whole lot of people do when they play the game of Monopoly is you can actually mortgage your properties right when you buy them. So for example, looking at Connecticut Avenue here, if you were to purchase it right away, you could then turn around and mortgage it and take $60 back of your purchase price and use it to help you purchase more property as you cruise the board. Now, one of the key advantages to doing this is you have more cash available on hand to buy properties outright or to compete in auctions. That way, if you land on a property, you're less likely to have a problem having the money to buy it outright. Because when properties go up for auction, typically they go up for auction for greater than the printed price on the board. The disadvantage of mortgaging your properties in the game of Monopoly is that you can't collect rent on mortgaged lots of land, but on the flip side of it, you get that benefit of having more cash now. To unmortgage the property, you need to pay the amount that you mortgaged. So for example, on Connecticut Avenue, if you mortgaged it for $60, not only do you have to pay the $60, but you also pay 10% interest, regardless of how many turns have passed throughout the game. So you pay $66 to get it unmortgaged. And you can only build on unmortgaged lots. So you might want to, if you're just starting to build houses on your properties, you can unmortgage them one at a time. And because you have to build evenly, you can build your first house on the first property you unmortgage, and then unmortgage the second property, build a house, unmortgage the third property, build a house. But that can only happen if you have a monopoly. So one of the key pieces of the game Monopoly is you need to negotiate your way into having a monopoly in the first place so that you can do the pay off your mortgages and build side of it. One little known piece of the Monopoly game is that each property section has its own sweet spot where you maximize the gain associated with buying the houses and building the houses on the board. So for Connecticut Avenue, for example, the sweet spot is when you buy your third house. Because when you look at the one house rent versus lot rent, you've got $32 difference there. The difference between two houses and one house is $60. But the difference between two houses and three houses is a whopping $200. And then the difference between 3 and 4 is only $150 for a maximum of $450. So, little known fact, there is a sweet spot on each of the Monopoly sections. Usually it's at about the third house. So you want to build to the third house as quickly as possible before trying to negotiate for a second Monopoly. That way you maximize your cash flow. And then once you have income, you get to start trading in these 4 little houses for a red hotel to make deadly landing spots for your opponents. That way you get to free up the amount of houses you can build on the board as you continue to play the game. But that's the game of Monopoly. Now, playing Monopoly in real life, we're not looking to bankrupt everybody else. What we're looking to do is to build lasting generational wealth and cash flow to supplement and become our financial freedom. At least that's what my goal is in real estate. If you've got a different goal in real estate, by all means, go ahead and share it in the comment section down below. I'd be really interested to hear what your specific goals are. Let's move on to the magic of exchange. So the magic in Monopoly is that it teaches us to trade 4 green houses for a red hotel. And in real life, what we end up doing is we can use this little known tax rule that lets us use all of the capital gains associated with the sale of a property or many properties, and then use that to buy a property of greater or equal value. So you might sell 4 little green houses and buy an apartment complex with that money. That could be a very good thing to do. So next, let's talk about benefits. Benefits are always great, right? Now, first off, the little known rule is called a 1031 exchange. So it comes from the subsection of the IRS code that outlines the benefit. Now, what it does is it defers your capital gains taxation. So say you had a house that you bought for $100,000 and you've owned it for 28 years, so you can't depreciate it anymore. Now your only basis left is your land value. Oh, and over the years, the house is appreciated to being worth $200,000. And say the land value was $10,000. So if you were to sell it for $200,000, your total net gain in terms of capital gain would be $190,000. Now, if you were just to sell it, your capital gain would be $190,000, and you'd have to pay 15% of that for federal capital gains as of the tax rules associated with the day that I'm recording this video. Could change depending on what Congress decides to do and what the president decides to do. But let's go ahead and just use the 15% number. And just to make easy math, let's say $200,000 is your gain. So you'd be taxed $30,000. Well, I don't know about you, but I'd rather keep that $30,000 and be able to invest it in a better property that's going to create more cash flow for me and my family. So I'm going to use this thing called a 1031 exchange. So you get to invest the full gains into your next property, and you get to restart depreciation on the next property. One of your biggest tax write-offs on rental properties is the fact that it depreciates over time. So you get to restart that clock from full. And one of the coolest things about this 1031 exchange is even though you're deferring capital gains taxes, which means if you sold a property and then bought an apartment complex and then sold the apartment complex without using another 1031 exchange to buy another apartment complex, well, at that point, you would be responsible for the capital gains associated with both the original house that you sold and the apartment complex. And that's just not a fun thing. But what you can do is if you were to keep using 1031 exchanges throughout your real estate investment career, then you can pass the properties onto your heirs, and all of the capital gains associated with those properties and the 1031 exchanges that you did while you were living, all of that goes away because your heirs inherit the property at market value on the day that they inherit it or the day that you pass away. You're going to want to double check with a tax attorney or an accountant just to get the details on that. But the basic idea is all of those capital gains taxes that you were deferring the whole time you were alive, they go away and your heirs get to enjoy the benefits capital gains tax free, at least up to the new adjusted basis that they inherit the property at. Now, in order to get these benefits, you have to fit some very specific rules. There are 7 rules associated with doing a 1031 exchange. And I'm going to give you the basics, but you're going to want to consult, once again, a tax professional to get all of the specifics before you look to execute on this strategy. I just want to make sure that I provide you the information to let you know that it exists as of today and has been existing since the 1970s. So you can use it in your real estate investing. The first rule associated with the 1031 exchange is you need to be purchasing and selling like-kind property, which means for our purposes, it needs to be investment property. So you can't sell the house that you've been living in to buy an investment property and expect to use the 1031 exchange to defer your capital gains. Instead, if you've lived in the house for a certain period of time, there's actual exemptions to capital gains taxation up to $250,000 for a single person or $500,000 for a married couple. So you already have the benefit of that on your owner-occupied property. But once again, you want to talk to a tax professional so that you know what your liabilities and your obligations are for that. The second rule is that it's got to be investment or business property only. Once again, it's very similar to Rule 1, but it's very important that it is only investment property. Now, this doesn't mean you have to do a one-for-one. You don't have to sell only one house and only get one apartment complex. What you can do is you can sell 4 houses and buy one apartment complex. Or you can sell an apartment complex and buy 10, 20 houses. That's perfectly fine. We'll talk about implications of that in the next rule. Rule number 3 is that the properties that you're buying need to be of greater or equal value to the property that you sold. So say, for example, you're selling a $200,000 house. You need to buy a property that's worth at least $200,000. Now, for most of us, we're selling property to move up so that we can increase our cash flow and enjoy economies of scale for having more units. So I would be selling 4 of my houses to get a 30-unit apartment complex, for example. That would be really awesome. And in fact, that's something that our family is looking to do in the near future, if we can find a suitable apartment complex to make that work. Next, you must not receive boot. What that means is you can't take any extra money out of that sale away from the purchase. So say you sold the $200,000 house and you're buying an apartment complex. Well, you need to use all of your proceeds to buy the apartment complex. You can't take $10,000 and go on a cruise or a big vacation and say, woo, we bought an apartment complex. No, you could do that, but you would pay capital gains taxes on whatever you took out. So if you took out $10,000, you'd pay your $1,500 in capital gains taxes and keep the remaining $8,500. That's only from a federal capital gains tax perspective. You may live in a state that has state capital gains taxes, so you want to double check with your tax professional on that. Rule number 5 is it's got to be the same taxpayer, or someone that is the same taxpayer has to be involved in the sale. So for example, if I, Michael Richter, am selling a property, well, I also need to be involved in the purchase, and it's got to be my taxpayer ID, my social security number associated with that. One exception to that rule is that I can use a sole member limited liability corporation because it's a pass-through entity. It doesn't have its own tax standing or consideration. I can sell a property that I own and it's titled in my name and purchase it through a sole member limited liability corporation. That's perfectly fine. But what I can't do is I can't sell one of my properties and then buy a property with a partner that isn't my spouse. Next, rule number 6. There is a 45-day identification window. So 45 days from when you sell the original property, you need to identify like-kind properties that you're looking at for the exchange. Ideally, you're already working on the transaction and you're just waiting on the proceeds to apply to the new transaction. That's ideal case, but you at least have to have properties identified by the 45-day mark. Also, rule number 7 is that the purchase of the property needs to occur 180 days or less from the closing of the original property. So that's about 6 months, but to be precise, it's 180 days. Once again, ideally, you've already started working on the purchase of the previous property and you're just waiting on the proceeds from the original property so that you can put it in a trust and apply it to the purchase of the new property. Now that we've gone over the 7 rules, I have to re-emphasize the key pitfall associated with the 1031 exchange, and that is the taxation is not eliminated unless you die. Then your capital gains taxes are eliminated and it passes to your heirs at their new adjusted basis. But the taxes are deferred while you live. So if you sell the house, buy an apartment complex, sell the apartment complex and want to move to Tahiti and use that to buy a mansion for yourself, well, you're going to get hit with capital gains taxes, not only in the amount of the proceeds from the apartment complex, but also for the house as well, because the taxes from the sale of the house were deferred to help you purchase the apartment complex. So that's definitely a big pitfall. So be aware of that. And once again, make sure that when you're planning on these large, sophisticated real estate moves, that you have competent advice and great people on your team to steer you in the right direction to maximize your use of the rules. Because the rules are there to be used for our benefit. And that's a great thing. Some people may say that we're trying to avoid taxes, but we're paying exactly what we owe and no more than that, and finding creative ways to use the tax code to our benefit. And that's one of the greatest things about real estate is there are so many tax benefits associated with it. So now that we talked about the rules and the biggest pitfall associated with the 1031 exchange, let's recap what we talked about. So initially, we talked about the game of Monopoly and how awesome it is and how to play the game of Monopoly and some of the basics, as well as an extra couple of bonus tips that you may not have been aware of. The fact that you can mortgage a property right away, you don't have to wait until you're in dire straits, and the fact that there is a sweet spot as far as maximizing your incremental value in terms of building houses. Usually it's at the 3-house mark, but you want to check the individual property card to verify. Next, we talked about the magic of exchanging 4 little green houses for 1 red hotel. But in the game of life, we end up trading houses for apartment complexes or apartment complexes for houses or whatever benefits us the most, because usually we're transitioning from one stage of life to another stage of life. For example, if you've got property in an appreciating area, you might want to sell off your appreciated assets to move your money into an area of the country where cash flow is usually what you're going to find in a property. That way you can sell off your higher end single family houses and buy apartment complexes that provide you more cash flow, and then you can retire off of that, which is awesome. We also talked about the benefits of using the 1031 exchange, including deferred taxation and the fact that you can use all of your proceeds and all of your capital gains to buy the next property, and the fact that if you keep deferring your gains until you pass away, you can pass your heirs the properties with an adjusted tax basis based on the market value of the property on the day they acquire it or on the day you die. You need to check with your tax professional on that. And we also discussed the rules of using a 1031 exchange. The biggest ones being you need to be selling investment property and buying investment property. They need to be the purchase that you're making needs to be of greater or equal value to the property that you sold, and you have 180 days to make it happen. Those are the biggest rules that end up tripping people up, but keep those things in mind. And finally, we also talked about the biggest pitfall of using a 1031 exchange, the fact that taxes are only deferred, they don't go away. So you want to make sure that you're using the 1031 exchange wisely, and every time you're using it, or if you have used it in the past, you want to make sure that you are maximizing your benefit and using your capital and your money wisely. And you can pay an advisor to do that on your behalf so that you're paying for their professional advice and you're getting the maximum benefit from it. This is about the time of the video where I ask, hey, if you got substantial value from the video, or if you like the content, by all means, please give it a thumbs up. I'd really appreciate it. Also, if you have any questions or comments, by all means, put them in the comment section down below. If you'd like more of this kind of content, go ahead and subscribe. And if you want to be notified anytime new content is brought up from this channel, by all means, hit that little bell symbol next to the subscribe button so you can adjust your notification settings. And if this is of any great value to friends of yours, by all means, go ahead and share, because I'm making this widely available so that other people can benefit just as I've benefited. So this is about the time where I say, have a fantastic day.